With random walk, Burton Malkiel asserts that price movements in securities are unpredictable. Because of this random walk, investors cannot consistently outperform the market as a whole. Applying fundamental analysis or technical analysis to time the market is a waste of time that will simply lead to underperformance. Investors would be better off buying and holding an index fund. Burton Malkiel offers two popular investment theories that correspond to fundamental analysis and technical analysis. On the fundamental side, the firm foundation theory argues that stocks have an intrinsic value that can be ascertained by discounting future cash flows, earnings. Investors can also use valuation techniques to ascertain the true value of a security or market. Investors decide when to buy or sell based on these valuations. On the technical side, the castle in the air theory assumes that successful investing depends on behavioral finance. Investors must determine the mood of the market, bull or bear. Valuations are not important because a security is only worth what someone is willing to pay for it. Random walk theory jibes with the semi-strong efficient hypothesis in its assertion that it is impossible to outperform the market on a consistent basis. This theory argues that stock prices are efficient because they reflect all known information, earnings, expectations, dividends. Prices quickly adjust to new information and it is virtually impossible to act on this information. Furthermore, price moves only with the advent of new information and this information is random and unpredictable. In short, Burton Malkiel attributes any outperformance success to lady luck. If enough people try, some are bound to outperform the market, but most are still likely to underperform. A non-random walk down Wall Street is a collection of essays offering empirical evidence that valuable information can be extracted from security prices. Andrew W. Lowe and A. Craig McKinley used powerful computers and advanced econometric analysis to test the randomness of security prices. Although this book is a heavy read, the findings should be of interest to technical analysts and chartists. In short, this book documents the presence of predictable components in stock prices. Just prior to this book, Andrew Lowe wrote a paper for the Journal of Finance in 2000, Foundations of Technical Analysis, Computational Algorithms, Statistical Inference, and Empirical Implementation. Harry Mamaisky and Zhang Wang also contributed. The paper's opening remarks say it all. Technical analysis, also known as charting, has been part of financial practice for many decades, but this discipline has not received the same level of academic scrutiny and acceptance as more traditional approaches such as fundamental analysis. One of the main obstacles is the highly subjective nature of technical analysis. The presence of geometric shapes in historical price charts is often in the eyes of the beholder. In this paper, we propose a systematic and automatic approach to technical pattern recognition using non-parametric kernel regression and apply this method to a large number of U.S. stocks from 1962 to 1996 to evaluate the effectiveness of technical analysis. By comparing the unconditional empirical distribution of daily stock returns to the conditional distribution conditioned on specific technical indicators, such as head and shoulders or double bottoms, we find that over the 31-year sample period, several technical indicators do provide incremental information and may have some practical value. This paper can be found at www.nber.org.